Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hope all of you had a very good day. And in today's markets, guys, well, the bulls have done the near impossible. They have now completed the actual V-shape improbable recovery. And the reason I say that it's very improbable, guys, is because usually when we get such big moves to the downside, it is usually a two-step recovery process. We saw it back here in the month of April when we had a steep decline, two-step recovery process back into a daily uptrend. We saw it last fall during the sell-off as well. Usually in times of uncertainty, when you get large market sell-offs, it is met with at least a two-step recovery process whenever you get a big leg of selling down. And then at the end of October, only at the end did we finally get our V-shape recovery and then into a two-step recovery process. But the V-shape, guys, is not the expected move. That is the unlikely scenario, but happy to see that the bulls have actually got it done against very, very high odds. So in today's video, guys, we're going to explain why exactly the bulls went on such a tear today. That was off the back of some bullish retail sales data. So number one, we're going to cover that retail sales data and see why it was so bullish, and also get a gauge of analyst expectations into whether or not we're expecting a soft or hard landing potential recession. Number two, we're going to go through a few earnings that I have prepared for you guys, and those are going to be the names of AliBaba, which reported this morning before the open, Walmart, and also John Deere. So very interesting reports to cover for you guys. We'll do that in the second segment of the video. Then third, we're going to go through our major technical analysis rundown of our major stock market indexes, then our big tech names, and see whether or not the bulls have it in the bag or whether or not we have some nice dip opportunities remaining across big tech names too. And then lastly, guys, we're going to take a brief look into my portfolio for the trades wrapped up today and the only trades left remaining for the week. So without further ado, guys, a lot to cover today. Let's jump right into the action. So SPY up 1.71%, QQQ up 2.53% on the day. Very nice broad market day as a whole. Take a look at your heat map right here. Everything pretty much in the green, most of all big tech. All of your semiconductors having a very nice day of recovery today as well. And really the bottom half of the market pulling its own weight. Financials, healthcare doing well, and the defensive names as well. Very, very broad market day of performance, that's for sure. You can see that even better on the one-day relative here. All of your major sectors pretty much in the green, which brings us to a one-week relative now with that V-shaped recovery bounce. Everything back into the green. But take a look at the 1 month, guys. There is still a heck of a lot of deals across the entire market right now. Not everything has rebounded from the 1 month ago price point. Only utilities, defensives, healthcare, and real estate remain positive, and everything else still remains to the downside. So I do still maintain, guys, there is a ton of opportunities left in the market right now. So do not feel any form of FOMO. We go over a lot of these plays regularly on the channel. And then when I go into my trading account at the end of the videos, you can see what types of plays I am going into. And usually I don't chase the market. I go for everything that's still being kept relatively at low prices. So that being said, guys, before we get into more technical analysis, let's jump into the reason behind today's monstrous continuation rally. So it's definitely in the retail sales. So take a look right here. Retail sales estimates were supposed to come in at about 0.3% on a month over month change. And we got, as a matter of fact, 1%. So 3.5 times better than the estimate. So what exactly happened here, guys? Well, let's take a look. Consumer spending jumped in July as retail sales were up 1%, much better than expected. So gains in sales were propelled by increases at motor vehicle and parts dealers by 3.6%, electronics and appliance stores rose 1.6%, and food and beverage outlets 0.9%. Miscellaneous retailers saw a plunge of 2.5%, which we've been seeing pretty much that consumer discretionary spending, especially for things like clothing, right? While gas stations saw receipts climb just 0.1%, and clothing stores were down 0.1% as well. So here's your retail sales advance, guys. You can see it is looking fairly healthy, but in all aggregate data, guys, we really haven't moved the needle that much since November and December of last year. So retail sales, although this month on a year-over-year comparison was good, we really haven't gone anywhere since last December and November, which just goes to show, guys, yes, consumers are still spending, but they're not excessively spending, right? It's still very, very mixed and very, very weak, especially across your lower income cohort of the economy, right? Now, This is why I say, guys, we have so much conflicting data right now. Once again, this was further evidence that the US consumer still has the ability to surprise to the upside. This was another solid report and inconsistent with a consumer who is on the brink of collapse. Just goes to show you guys how mixed the data is right now. And I always maintain this on the channel, guys. Very important to stay data dependent. But right now, the data is just showing very mixed signals. So we have to be careful in the markets. Yes, we are still bullish overall. However, we are cautiously optimistic at best, right? We're not full YOLO bulls right now. Cautiously optimistic is the best way to describe it, because there are certain red flags starting to form right now, but nothing truly crazy in terms of the data, especially to the negative side, right? So let's take a look at some of your analyst expectations here in terms of soft landing, no landing, or hard landing. And you can see now for the month of August, 76% of all analysts are of the opinion that we are going to get a more soft landing scenario. Only 8% now are forecasting for a no landing, which means no form of recession or economic slowdown whatsoever. And a hard landing is a deep form recession that usually takes over a year to get out of. Only 13% of people thinks that's going to happen. So the middle part, guys, is usually the ones that are correct, right? Your consensus is usually in 95+% of chances always going to be correct. So I do agree with them, guys. Yes, we are seeing consumer slowdowns. We're seeing manufacturing slowdowns as well. But is the consumer now grinded down to a complete halt? And are people losing their jobs by the hundreds of thousands? No, not yet. So we're going to remain data dependent, guys, and just play the markets as we always do, right? The thesis has always been the same. When we get very rapid and significant drops in the market, we need to focus on the highest quality companies. So for buying shares, you've seen me do it over the last 3 weeks. I'm buying shares of the most solid companies in each of their industries. And we continue to just sell options, because that's the best way to profit from volatility, is just selling options at prices that you wouldn't mind being assigned in the case of short puts, the one that we run on the channel more specifically, right? Let's take a look as well at some of your cash positioning from institutions. Sorry if the chart's a little bit blurry, guys. It just came like that. It's really not me or anything. So here is your Bank of America global cash levels, right? That managements across the world pretty much are holding in terms of their portfolios, right? So you can see here, we are still at relatively low levels in the grand scheme of the last 25 years of data. People are only really holding on to 4.3% as a cash position, a stark contrast from the highs of 2022, and even the stark contrast from the highs of the pandemic in April of 2020, right? So definitely not positioning for a hard landing recession, that's for sure. So as I said, guys, we'll continue to remain data dependent and play this volatility accordingly, one day at a time, focusing on the highest quality companies, because even if there's a economic slowdown, or if the markets turn volatile and go red once again, at least we know the highest quality companies in the world usually tend to be the ones that bounce first. So hopefully that makes sense. So now that we've gone through that, let's jump into a few earnings that I have prepared for you guys. And number one is going to be Walmart. So Walmart coming out over almost 7% gain on the day here, guys, today. You cannot slow down Walmart. They're just such a solid company, especially in the midst of a recession. If anything, people even start shopping more at Walmart. So let's get into some of their numbers, right? So their numbers, very, very fantastic, guys. Nothing bad to say about the company. 3.66% beat on EPS and a 0.5% beat on revenue. Now, let's take a look at some of the articles right here. Then we'll dive into the valuation, of course. So Walmart beats estimates, raises outlook as it sees a stable consumer in terms of the health. Very, very stark contrast in relation to what a lot of other companies were saying. It just goes to show you how defensive of a company Walmart truly is. Moving down, Walmart raised its forecast for the year on Thursday. So not only did they have a double beat in terms of earnings and EPS, they raised their guidance amidst economic uncertainty, right? Fantastic for them. Quarterly revenue grew nearly 5%, and company stores and website drew more visits, and sales outside the grocery department improved. Walmart said it now expects sales to rise by 3.75 to 4.75% for the full year. The expectation was from 3 to 4%. So there's your increase in guidance for sales, and here's your increase in guidance for EPS. Prior forecast, 235 to 243, this is the current forecast, 235 to 243. Prior forecast, 223 to 237. So a nice little 10% increase in EPS and almost a 1% increase in the sales guidance, guys. Really good. Not only are they growing top line revenue faster, but they're improving margins and profitability faster as well, as viewed by the EPS increase. Very, very solid here, guys. Here's what the CFO had to say, John David Rainey. He said the company's brighter outlook reflects strength in the first half of the year. He said Walmart decided against raising expectations for the back half of the year, especially since the 2024 election, unrest in the Middle East, and other dynamics may influence consumer sentiment. So most of this guidance is coming from your first half of the year. They didn't really touch it for the second half. So normal for them because of economic uncertainty right there, but still fantastic expectations for the remainder of the year. In this environment, it's responsible or prudent to be a little bit guarded with the outlook, but we're not projecting a recession. Very key information there from the CFO of Walmart. They have some of the best consumer data in the entire game, guys. So when they say something, you have to listen. The companies that had the most strong consumer data, in my humble opinion, were companies like JP Morgan, Visa, MasterCard, Walmart, and pretty much Amazon. They have the most consumer data in the world, and all 5 of those companies, even though they noticed a slight consumer slowdown, they are not forecasting a recession. So take it from the biggest companies in the world. They have the data. We do not, right? So he said Walmart has not noticed a shift in consumer behavior. He said every month of the quarter was relatively consistent and the back to school season is off to a pretty good start. We see among our members and customers that they remain choiceful, discerning, value seeking, focusing on things like essentials rather than discretionary items. But importantly, we don't see any additional fraying of consumer health. So there's pretty much everything we've been saying on the channel, guys, for the past 2 months, right? In a nutshell, explained by the CFO of Walmart. So here's your same store sales rising at 4.2%, obviously down, of course, from the highs of 2023 and certainly during the pandemic. But Walmart traditionally, right, in a normal environment prior to the pandemic, we don't have the data here, but usually that's how much Walmart does grow same store sales on a year over year basis, anywhere between 4 to 6%. So this is well within the company's historical averages. E-commerce sales, also 22% growth in e-commerce sales measuring year over year comparisons. That is extremely strong, guys. Obviously, you can't really look at these numbers here, 2020 and 2021, because everybody was stuck at home and ordering online. So these are anomalies, but these 22% growth rate for e-commerce in this type of market is really substantial growth, guys. Walmart's customers in the US visited the company stores and website more and spent slightly more during the quarter than they did in the year ago period. Transactions rose 3.6%. And the average ticket was up 0.6%. So extremely strong numbers from Walmart here. Walmart, for its part, says it's pushing vendors to reduce prices. Rainey said that's been a long focus for the company. So they're really driving prices down for the consumer by putting pressure on the suppliers, right? That is where your deflation comes from, guys. First, it comes from your suppliers decreasing their prices because they're building up inventory, and then Walmart can then transmit those savings on to you, right? And trust me, they do have a lot of room to wiggle with because we know that suppliers had increased their prices tremendously since 2022 because of inflation, and now they're slowly trending down. And that's what we saw 2 days ago when we got the producer inflation report, right? So moving on further, he told CNBC that inflation was flat for Walmart year over year, so its sales growth was driven by selling more units rather than higher prices. Very good. He said it had 7,200 rollbacks or short-term deals on items in the quarter, including a 35% increase in the numbers of rollbacks on food. Going to show you guys, inflation on food is largely done. Now, along with attracting inflation-wary shoppers, Walmart has made it its own moves to drive growth. It has looked outside of traditional retail channels as it has sought to add more sellers to its third-party marketplace, sell more advertisements, and attract more members to its subscription service, Walmart Plus. It also launched a new grocery brand, Better Goods, which with most items under $5, including meal solutions like frozen pizzas and chicken wings. This is Walmart trying to capitalize on the trend right now of people spending less money on food away from home. So they're trying to get people to buy that brand instead of going out to eat. Extremely solid quarter from Walmart right here. Nothing bad to say about the company. Let's take a brief look at just a few of their slides. Not going to spend too much time on this, but yes, we did have an increase in your net sales guidance right here, but I want you guys to look at the operating income guidance, an increase of 6.5 to 8% instead of 4 to 6%. This is really big, guys. Not only are they increasing guidance for top line revenue, but they're saying they're getting even more efficient and getting better margins. That is absolutely phenomenal for Walmart. No problem at all with this company. As you can see, total net revenues are substantially higher. Gross profit rates are increasing, as I was showing you guys with your operating margin guidance to the upside. Right? Moving on down, operating income as well, that is just steadily increasing as well. Nothing wrong with this company whatsoever, guys. Adjusted EPS, always on the increase here as well. Cash flow, right? Even though last quarter was a bit of an anomaly in terms of free cash flow, they did bring in $5.9 billion in free cash flow over the course of this quarter, and they still have about $14.5 billion in cash flow to utilize for share buybacks. That is very, very strong for Walmart. Now, it's not that big in terms of Walmart's market cap, right? Walmart's market cap right now is sitting about 588 billion. So 15.4 divided by 588, it's only about 2.6% of their outstanding float that they have for buybacks, but at least they are still doing some every single quarter, as you can see, right? Very high return on assets as a company, very high return on investment as well. They utilize all the cash that they have very, very well. Here's your US comparable store sales, 4.2%. So coming back, slowly coming back from the little dip that we had over the last 2 quarters, extremely strong. International net sales as well, even though it has been down over the last couple of quarters, it is fairly stable right here. So no problems there as well. That's pretty much everything I wanted to show you guys. We can obviously go through their different segments and whatnot, but I don't think it's very pertinent to our analysis right now. All you have to understand, guys, is Walmart is operating on full cylinders across all markets, and they do not see any meaningful chance of a hard recession for their consumers, at least, right? So moving on to the valuations here, guys, obviously Walmart is at the all-time highs right now. And in terms of the valuation as well, it is not the cheapest, right? So revenue growth of about 4% per year, EPS growth of 11% per year. You can see that even better when we pull up the progression chart. So very stable EPS growth, very stable revenue growth as well. Walmart is such a solid company here, guys. Your 2024 forward PE at 73 bucks is about a 29.8. Now, 29.8, guys, is kind of rich on a historical basis. Take a look at your historical basis right here. You will see that right now, that's exactly where we are on a trailing, but also on a forward, guys, it is still a 29. It's a little bit high, right? It's not at the lows that we had back here in the lower 20s. So it is a tiny bit rich in terms of historical standards. Now, the PEG ratio as well, even though they don't have that much EPS growth, we can still derive a PEG ratio, 2.71, high, not the best for Walmart either in relation to its most recent history. And even the free cash flow yield, right? A more defensive metric of valuation. Free cash flow yield at 2.5%, guys, that's very low, right? Anything between 3.5% and 5% for legacy companies like Walmart, Visa, MasterCard, Microsoft, things like that, right? The most high quality companies in the game right now. You would expect, if you want to see a company at a good deal in terms of share price, you need to see free cash flow yields between 3.5% to 5%. So at 2.5, guys, it's not the best deal in the business right now. So in terms of the valuation, guys, valuation of Walmart is slightly stretched right now. But if you're a long-term shareholder on Walmart and you have shares from anywhere all the way back here, this is definitely not a reason to sell your shares at all. It is such a solid company. I'm more speaking for people who are looking to start a position, open a position in Walmart. May just not be the best time right now in terms of doing that. Usually you'd want to see Walmart on a more of a stable trend like this, right? Back in the early part of the year where they consolidate sideways for a long time, build a little bit of a shelf of support, then we can start picking it, and then we have a rally. But chasing it right now, after it's rallied so much, back into weekly overbought conditions, into almost daily overbought conditions as well, not the best risk to reward for a swing trade, in my humble opinion, right? So that's pretty much everything for Walmart. Extremely solid earnings, extremely solid company. It's just chasing the company up here, guys. Maybe not the best value proposition in my humble opinion, but still nothing bad to say about the company. Now moving on to company number 2, guys, we're gonna be covering AliBaba. That is not AliBaba, so let's pull up AliBaba right now. So AliBaba coming in with earnings before the open today, and they were really very mixed, guys. So take a look right here. You can see big drop in the pre-market hours. We are pretty much down almost 5%, and we pretty much took it all back and more before pretty much ending the day flat. So very volatile day on AliBaba. Let's see exactly what happened for their earnings. And unfortunately, guys, they were not the best, right? We know Alibaba's been struggling, of course, over the last 3-4 years. Ever since COVID, the Chinese economy has been severely slowing down, right? We're still waiting for signs of that inflection point in the Chinese economy. As of right now, we just don't see the light at the end of the tunnel just yet. So let's take a look at the numbers. EPS beat by about 10%. That's very good for them, but a revenue miss by about 2%. A very rare, revenue miss. Usually Alibaba misses on EPS. Very rarely do they miss on revenue. So this was a occasion where they did. Let's take a look at the article real quick. So AliBaba earnings miss expectations despite cloud acceleration. Now, the cloud business, guys, is going to be one of the businesses that we need to pay the most attention to for Alibaba. It's a high profit margin business, and it is the one that is growing the fastest out of all their business segments right now. So let's have a look at the article. Alibaba missed top and bottom line expectations for the June quarter of 2024 as it continues to face headwinds in its core e-commerce business amid rising competition and a cautious Chinese consumer. So let's have a look. Revenue was up only 4% year on year, while net income dropped 29%. Definitely not the best for them. Alibaba said the net income fall was primarily due to a decrease in income from operations and especially an increase in impairment from its investments. If you don't know what impairment is, guys, is Alibaba obviously as a company invests possibly in different companies, in equities and stuff like that, right? Well, when the value of those investments drop, they can choose, depending on the quarter, to write that as a net loss and offset it against some of their income. So that was exactly what they did this quarter. Now, the e-commerce giant has been grappling with a cautious Chinese consumer, along with increased competition from rivals such as JD.com and especially Temu owner Pinduoduo. They have been really taking over the North American and European markets by storm right now, which is something that Alibaba is severely lacking behind in terms of marketing, in my opinion. Let's move on. It's currently going through a transition phase where the company is planning to put more focus on third-party merchants selling via its platforms, Taobao and Tmall, which is its e-commerce division, right, in China, while reducing reliance on its direct sales business. Wu has previously stated, the company CEO has previously said the company intends to release new monetization features for its e-commerce platforms that should return the Taobao and Tmall business back to growth towards the latter half of 2025. So they are really trying to get third-party resellers and incentivizing them to get more and more on the platform. In the June quarter, sales from the Taobao and Tmall group, which represents Alibaba's China e-commerce business, fell 1% year on year. Definitely not good for them, right? Now, let's move on. Meanwhile, Alibaba's overseas online shopping businesses, such as Lazada and AliExpress, continue to be a bright spot, with sales in the international e-commerce division up 32% year on year. The problem with that, guys, yes, they're doing okay internationally, definitely not as good as someone like Temu. However, this is not the bulk of their business. The bulk of their business is to the Chinese consumer, and that's the one that represents the most amount of revenue. So even though international was a bright spot, it's still not enough to offset the internal China weakness, right? Here's your cloud division. Cloud accelerates. Alibaba said quarterly revenue from the cloud group is up 6% year on year, the fastest growth rate since the June quarter of 2022. Very good for them, because this was a point of contention over the last few quarters. So nice to see them resuming with some high single-digit growth right there. Alibaba said AI-related product revenue continued to grow at triple digits year over year. So I don't know if you guys knew this, but Alibaba is, of course, in the cloud business and data warehousing business too, and they own about 6% of the market share. The leaders being, of course, Microsoft Azure, Amazon Warehouse Services at over, or Amazon Web Hosting Services at over 30% market share. Microsoft Azure is in the mid 20s. Google Cloud is about 11-12%. Alibaba is the next in line at about 6% total market share of cloud, right? So still a big measure for them. Now let's move on to some of the headlines here. So some of your financial highlights. Total revenue up 33.5 billion. I'll tell you guys what I like the most of Alibaba, and one of them is definitely this: their net cash position, guys. $55.8 billion. This is absolutely insane. The market cap of the company right now is $172 billion. They literally have just under a third of their entire market cap in straight cash. That is absolutely phenomenal for the company. So they can deploy that cash either for share buybacks as they've been doing, or possibly endeavors to grow the business. So they're not at risk of going bankrupt or anything like that, still an extremely strong balance sheet position. Now, they highlight the cash return to shareholders, guys. This is literally slide number 3. So they really want it to be front and center. I very rarely see this in earnings presentations, right? So this has to be one of the bright points of the company. During the quarter, they repurchased $5.8 billion worth of shares outstanding. That was a 2.3% net reduction. The remaining amount that they have is about $26 billion in share buybacks, and that is roughly 15.4% of the entire float of AliBaba. So the buybacks are definitely doing a great job of buoying up the share price, right? So moving on down, let's take a look at their net income numbers because the rest really wasn't good, right? 15% drop right here on income from operations year over year. Definitely not the best, right? All metrics, guys, slowing down. But how is their profitability? So their profitability was about 9.8%. Now, 9.8%, guys, is relatively lower than what we've been having in a few quarters in last year, right? Last year, we were used to 11, 14, 12% margins. This year, the slowdown has been accelerating a little bit more. You can see 5.5% 2 quarters ago, 1.5% last quarter, and this quarter about 9.8. So their profitability is somewhat slowing down more recently, guys. We're kind of nearing that inflection point, right? It won't be like this forever, but unfortunately really tied into the Chinese economy, and the Chinese economy just hasn't been doing the best as of lately. So moving on further, right, we want to show the net cash flow margins, right? So if you take a look at your net cash flow margins, you can see, or free cash flow rather, it's about 2.3 billion US dollars. Now that is also relatively light towards what Alibaba's been bringing in the past 2 years. Usually you expect them to bring in anywhere between $4 and $5 billion in free cash flow. However, they weren't able to do it over the course of this current quarter because they started investing heavily in property and equipment, most notably for their cloud division. That cost them roughly twice the amount of expenses that it cost them at the same period last year. So that's why we're missing about half of the free cash flow that we were to be expecting. But it's good to see them reinvesting in their business right now when they really need it, right? So all in all, not too bad of a report from AliBaba, but still there are some points of contention, right? They've been doing a good job of bringing their cost of goods sold slightly down on a year-over-year basis, but that is offset with some other expenses, product development expenses, most notably for their cloud division, up ever so slightly, sales and marketing expenses as well, up ever so slightly, and your general and administrative expenses are also up ever so slightly, guys. So all of those things are eroding profit margins right now, plus the investment in capital expenditures such as data centers and additional warehouses, right? So take a look at your revenues per segments broken down right here. Cloud Intelligence Group, 6% growth. Here's your China e-commerce group, down 1%. We saw that in the article. Your international, that's been a bright spot for them, 32% growth. The Smart Logistics Network, 16%. Local Services Group, 12%. Digital Media and Entertainment, up 4% as well, which gives you a consolidated growth of about 4%. But this is the one where it really hurts, guys, because you can see how much more revenue they bring in than all the other divisions combined. So all in all, very mixed quarter for Alibaba. Let's take a look at some of their valuations, shall we? So moving on into it, your forward PE ratio at $79, where we sit right now, is about a 9.81, guys. That is extremely cheap for a company that has this amount of cash on hand and this amount of buybacks to be doing. That is still growing EPS at a healthy 12% per year. Take a look at your EPS expansion curve. You can see that although this year is a transition year, we are forecasting for better growth in the next couple of years. And even revenue as well is forecasted to be expanding over the next few years too. So definitely very bullish over the medium and long term for Alibaba, but in the short term, we still have a few things to contend with, of course, right? So moving on down, that gives us a forward PEG ratio at 79 of 0.89. We divide the forward PE by your EPS growth rate, and we get a 0.89 PEG. That is extremely cheap for this company. And one of your more value-oriented metrics, your free cash flow yield, as I was saying with Walmart, right? 3.5% to 5% is very, very good. Alibaba sitting at a free cash flow yield of 12.2%, which means that for every share that you purchase, the company is able to return to you either through, well, depending on the company, right? Either through dividends or share buybacks. Every single share that you possibly own, they will return to you 12.5% in net cash, either through buybacks or dividends. That is extremely, extremely solid here, guys. So all in all, I really like AliBaba at these lower levels. I will continue to play it. If I can find it $75 and lower, guys, I will continue to play short puts on this one. I even have a long-term position in my long-term portfolio. It's not a very big one, but at least it's something, because although I do believe the company has its short-term headwinds, I really think that this valuation down here is cheap. AliBaba could really trade in the $120, $140 range and still be relatively cheap. The only reason why it's not trading there right now is, of course, the short-term headwinds of the Chinese economy. Every single China stock out there, guys, is extremely crushed right now. So it's just a question of being able to accumulate and hold the shares and wait for better days to come, which is why it's in my long-term portfolio. And when I want to take swing trades on it, I'm just eyeing for some short puts down below here, below the mid 70 points. And then we're looking to maybe take profits in the, 80 to 85 range. We're not looking for the moonshot call options, not just yet. I don't think they are ready. So moving on further here, guys, moving on down, we're going to cover company number 3, and it's also going to be a very interesting one too. AliBaba profit margins, just to recap this quickly, right? Gross margins have been declining ever so in succession pretty much since 2019, since the Chinese economy started slowing down, then the pandemic accentuated it, of course. Operating margins also down, and your net margins down too. So you can see margin erosion has been a problem for the company, but that will all get better when the Chinese economy recovers. So it's really beholden to that Chinese economy. Now, company number 3, guys, we're going to cover John Deere. So John Deere having one of their best days in the last 3 years here, guys. Up 6.26%. You usually do not see above 5% days on such a defensive name. But I was saying, guys, when John Deere enters this location right here, 360 down to 326, usually it's been a good value proposition buying it ever since the last 3 years worth of trading. Huge support level for the company. So let's see what exactly happened for them to get such a nice share boost. So they beat on EPS by 11% and they beat on revenue by about 4%. However, guys, their guidance and their actual numbers, yes, these numbers look good at a first glance, but keep in mind for the last 2 quarters, they have been sandbagging their own numbers. They've been guiding very, very, very low. So the bar was not very high to beat. And the outlook for the rest of the year, guys, is not the best, admittedly. So let's take a look at their earnings. Deere's stock climbs after earnings sweep past lowered estimates. So company books $124 million in charges to cover layoffs as it aligns production with weak demand. So obviously we know what the problem that John Deere is facing right now. It is high interest rates. Why would you go out and buy a $500,000 tractor or piece of farm equipment when interest rates are so high? You may as well wait for the interest rates to come down because it's such a high ticket purchase, right? That essentially is what's been hurting John Deere's demand for the last year and a half at this point. But management, in its defense, has been doing the best that it can to mediate that fall in demand by managing its costs a lot better. And unfortunately, a byproduct of managing those costs has been laying off some of their employees. But it's like a necessary evil, guys, right? When a company goes through a slowdown, it has to keep itself alive through as many cost reductions as it can. So estimates came down after the company reduced guidance for 2024 in May and later announced plans to cut an undisclosed number of jobs to better align production with demand. So John Deere's third quarter results showcase our disciplined execution in the face of challenging conditions in the global agricultural and construction sectors, said the CEO, John May. Most of the programs were involuntary, talking about the layoff programs. Most of them were involuntary, so they fired people. It's not that people left voluntarily, they had to actually fire them. Deere did not disclose how many staff were laid off, but it expects the total pre-tax cost to come to $150 million for obviously the layoff packages, right? And the savings to total about $230 million in the next year, of which $100 million is expected to be realized in 2024. So at least they're saving a little bit of money, but very unfortunate for those people who lost their jobs, of course, right? Now, although these decisions were difficult, they are vital for our continued success and competitiveness. By segment, production and precision agriculture sales were down 25% in the quarter. Small agriculture and turf sales fell 18%. These are not small numbers, guys. These are very, very big sales declines. Also due to lower shipment volumes. Construction and forestry sales fell 13%. By segment, the company is expecting production and precision agriculture sales and small agriculture and turf sales to fall 20 to 25% in the year. Very bad guidance, of course, guys, but we knew this as of the last 2 quarters. While construction and forestry sales are expected to fall 10 to 15%. So really all across the board here, guys. So why was the stock up? Well, one of the analysts, exactly as the analyst said, the investors were likely expecting the numbers to be far worse. It's not that bad, particularly in the 2 agricultural segments, right? So just a case in point, guys, when you expect things to be really, really bad, similar to Starbucks' earnings, right? You saw what happened when Starbucks came in just a few short weeks ago with the most terrible earnings anybody's ever seen. But people were expecting them to be far worse, and the stock went up 5%. Same thing happened with John Deere. To be fair, they had been warning about this for 2 quarters, which is why it's not a surprise right now. Let's move into some of their sales numbers, guys, and you will see also it's just not very good for the company, right? So take a look right here in terms of our guidance, right? So here's our 3rd quarter and some of your guidance. Net sales and revenues across all of your divisions. Production and precision agriculture sales, 25% of the downside. Small agriculture and turf net sales, 18% of the downside. Construction and forestry, 13% down. Now, financial services revenues, they're up 21%. That is financing that you obtain through a John Deere dealership. That obviously is to the upside because interest rates are higher, so they make more margins on those, right? But all in all, not a very good quarter for John Deere. Now, look at your operating profits as well. Have these revenues, despite of John Deere's cost cutting, have they cut into profits? Well, the answer is unfortunately yes. Production and precision agriculture, 35% down in terms of operating profit, guys. That is huge. Small agriculture and turf, 32%. Construction and forestry, 37%. Financial services, profit margins eroding by 33% here as well. Total operating profit down a whopping 35%. But they did not change their guidance for the year here, guys. Apparently, they are still able to meet their end of year lowered guidance. So essentially what they're saying is that it won't be getting any worse than this, right? Now, in terms of a recovery story for John Deere, undoubtedly, we're going to have to wait for interest rates to come down, guys, because this is a very cyclical business, right? When interest rates are high, nobody buys their equipment. But when interest rates come back to being lows like they were in 2020, right? Company can consolidate here for a long time. Look at this, 2018 to 2020. This was also a 2.5-year consolidation, similar to exactly what we're getting up here. And then when, obviously this was fueled with free money and low interest rates, right? You get a massive breakout. Now, I'm not saying the breakout out of this area would have been so severe, without those interest rate cuts, but you probably still would have broken out of that channel to the upside. Very defensive company, right? But you see what happens when interest rates are low. Everybody goes up and remodernizes their equipment, shops for new tractors and combines and construction equipment, stuff like that, right? So in terms of their numbers, let's take a look at some of their numbers here, guys, and you'll see they're really not that bad. So revenue growth, 6.8% per year, EPS growth, 14.2% per year. That is after 2020, this current year right now, because this year obviously is at a slight decline, even into the early parts of next year before resuming thereafter. So at least they will be growing thereafter. I think I actually have to revise this to the downside. This was from last quarter. This is probably closer. What I was reading is closer to about 8-9%. Doesn't matter. We're not going to do a PEG ratio anyways. Just understand that it's relatively lower. I can actually put it right here. It is about 8% right now. So let me just do that right now. So they have dropped their EPS real quick. So moving on further, their EPS growth, 8%. You can see right here that their forward PE at $372 is about a 14.82. That is relatively low in the history of John Deere, admittedly, guys. It's a very low multiple for John Deere for such a defensive company, usually, right? I know that they're cyclical and that interest rates are hurting them right now, but when interest rates come down, this company should prove to be one that does quite well. Take a look at their profit margins established over the last few years, guys. They've really raised the bar a lot, which means that they have some margin of error right now that they can afford to kind of give back in these times of uncertainty and of low demand. Take a look at your gross profit margins. They've been expanding nicely, guys. All throughout this consolidation, John Deere has been protecting its profit margins as best as it can. You can see your operating margins now are at highs, 15-year highs, right? Still in the lower 20% range. And net margins, even though net margins this quarter were down to about 14%, they're still relatively high in relation to the company's history, right? So they do have a good margin of error to work with, which is why you haven't seen this stock truly collapse like you've seen a lot of other consumer-facing brands be hit over the course of this past year, right? So in terms of a final say on John Deere, I really like this company for a long-term portfolio, guys. Nothing wrong with the company at all, and could be a great time to add to a position in the lower bound of this support range right here. Even for swing trading, guys, in this location, 360 to about 330, you guys have seen me take this swing trade so many times over the last year, and I will continue to do it every single time. I think the company is poised for long-term growth, and there won't be any problem once interest rates start to decline. Obviously, it's a slow recovery process after interest rates, but it will most likely happen for the company. In terms of their PE ratio, right? PE ratio in relation to the company's history, still at relatively low levels. The forward PE is about a 14. We'll see what happens with that. The trailing PE, however, is somewhat at the lowest it's been in the last 10 years of trading. So all in all, guys, John Deere does have its problems right now, but it is on the cheaper end of traditional valuations and into an area of consolidation. So I actually like this one for a little bit of a long here. So that's pretty much everything we had for our earnings today. Now let's jump right into our indexes, and you'll see, guys, we're going to jump through these quickly because really not much has changed. So give me a quick second. And let's get right into it, shall we? So the bulls pulling off the improbable, not impossible, but the improbable, guys. If you asked me, once we were down here, right, in this range right here, you asked me the probabilities of a full V-shaped recovery, guys, I would have given you probabilities of maybe 5-10%, because that's traditionally how much they are. Usually when you see a 6% drop on the SPY, you don't usually get a 7% recovery in the 2 weeks following. If anything, you get a multiple step recovery process as the market kind of irons out the details of why we crashed, right? But so far, guys, you gotta give it to the bulls, right? Extremely strong price action right here. So same analysis. As soon as this move tops out, now that we have a 100% engulfing bounce, keep a close eye on your hourly trend. Once we lose the hourly uptrend, that is when you're going to get your first form of daily consolidation. Now, where are we going to be looking for here, guys? Set up for the daily higher low for the daily trend change. Well, look no further than the area we just broke through. This was big resistance for the markets. Prior support, then it became resistance, and the bulls just blasted right through it as it's not even there. We are finally back above your short-term moving averages as well. So if we do pull back, I expect to pull back in this zone right here of support, 545 down to about 538 for the SPY. Your moving averages are there too, so could see a scenario in which we form maybe a daily higher low and possibly go for the daily uptrend shift. Now, where does that leave us on the weekly, guys? The weekly also a ultra rare V-shaped recovery on the weekly too. Now, I know we did it back here in the month of April, but when you zoom in on the April recovery, right, it was a multiple step process, which then did lead us into that weekly recovery process as well. This one is just an absolute pure V-shape. No daily uptrend was formed. So this weekly bounce right here is also looking extremely strong right now, guys. A recovery of about 80% on the weekly. Extremely good, guys. So even if we were to fall off on the daily for a little bit of a daily downtrend and lose this level too, well, the bulls have created a lot of space to set up for the weekly trend change attempt as well. So now the longer time frames are looking very good. Like the monthly is looking pretty good. The weekly is also looking a lot better than it did last week. And then the daily is just a 100% engulfing move with a beautiful chance at daily uptrend resumption. Congratulations to all the bulls out there. And congratulations to you if you were buying the dip with me all the way back down here. Now, admittedly, even myself, guys, I did not buy as much as I wanted to buy down there. We didn't stick around down there for too long, right? But at least we were able to buy something when everybody was fearful, when the markets were crumbling. We were in there buying and still playing the strategy as per our rules. So congratulations to everybody who was able to have a level-headed mindset and respect your own trading strategy and your set of rules. Moving on to the QQQs right now. So the QQQs, 2.5% to the upside, very strong day, 100% engulfing move as well. So the same logic follows, right? Now back above the moving averages. As soon as this move tops out, going to be looking for a daily higher low for a potential resumption of the daily uptrend. Where can we potentially be looking for that daily higher low setup, guys? I'd be looking in this location right here, right? Slightly below your moving averages, in line with your previous support right here, 455. Maybe just a breakout, retest, and reset of the daily uptrend. That would also probably be an inverse head and shoulders. Usually those get very good follow through on the weekly as well, looking pretty good on the weekly. Take a look right here on the weekly, 61.8% bounce. So even if the bulls choose to consolidate a little bit more on the daily time frame and even set up maybe a new daily downtrend, right? Doesn't matter. The bulls have a lot of space right now to reset this weekly chart into a weekly uptrend. And keep in mind on the weekly timeframes, guys, we're now back above this crucial area of support, right? This red box used to be resistance when we were under it. Now I can put it green because it will be support once again. That is 450 down to about 435. Now moving on to XLF financials. So XLF financials performing quite well today as well. 0.93% to the upside. Looking very, very solid, boosted a little bit by very good performance in Visa and MasterCard, right? Some of the names that I've been telling you guys to be buying over the last month and a half. So hopefully you guys have potentially taken my non-financial advice and looked into it on your own, right? So moving into technical analysis of it, financials looking extremely strong right now, guys, right? Beautiful daily uptrend formation on financials. So as soon as this move tops out, if we get stopped out here by our resistance at the all-time highs, just going to be looking for a daily higher low, anything above 4209, daily higher low for continuation of the uptrend. The reason I always bring up the daily higher lows, guys, is if there's any swing traders of you, right, that want to take these trades as a whole, you just identify some support levels down here. If you do get a retest, then it's very easy for you to place an entry right here. Your stop loss goes below the most recent higher low, and then you target the upside in terms of profit, right? So that's the type of setups that we're looking for in terms of direct swing tradings on these ETFs. All in all, XLF looking very good. And even on the weekly, guys, we've never really lost the weekly uptrend to speak of, right? It came very close, but never lost it. Now we're just looking for continued trend expansion beyond the all-time highs. So on the weeklies, looking very good. Once again, my favorite names, Visa and MasterCard. Now, moving into healthcare. Healthcare, new all-time highs, guys. And healthcare is just a tremendous performer when times get uncertain and we run into recession narrative. Usually healthcare is a very good name. Now, moving on further, guys, beautiful daily engulfing move, right? Never even bothered to stop and set up for the new daily uptrend. So as soon as this move tops out, could be looking for a daily higher low for further trend continuation. Now, where could we potentially be bouncing off of here, guys, if we do pull back? Well, target this area right here, prior all-time high resistance, now going to be acting as support, and you have your 12 EMA right under us right now. So if you pull a little bit of a breakout, retest the all-time high and run, that could be a very likely scenario for me. In terms of the weekly, what would support that is definitely the weekly uptrend, right? Gorgeous weekly uptrend expansion beyond the all-time highs. The bulls looking very, very strong on healthcare. Some of the names that I've been in healthcare recently, guys, is McKesson Corporation, trying to recover the trend that they've most recently lost, right? This company usually doesn't get hit with candles like this. So I am looking to play a little bit of mean reversion. Usually doesn't hover around the, you can't see that. Usually doesn't hover around the daily oversold conditions level too much. So we will I've made a play on this one for upside continuation. And another healthcare name that's been kind of beaten down as of recently is Merck. Merck also daily oversold practically and coming into a great area right now. Huge prior resistance, current support for the markets. And what are we looking for here? Just looking for the monthly higher low for maybe potential trend continuation. So those are some of the names. I got a little bit of an itch there. So those two are some of the names that have sold off in healthcare, which could be a decent opportunity for a rally to the upside. Now, moving into semiconductors. Semiconductor is putting in a fantastic day once again. 4.22% to the upside, looking very strong. So let me just change these boxes around in real time because now we've really blasted above them, right? So these boxes, they used to be resistance, they will now be support under the market. So looking very good. The next area of overhead resistance. So this one's green, right? So let me just change everything, guys. Sorry about that. I kind of been slacking off on the SMH chart right here. So moving on into the analysis, right? Resistance above us right now. Bulls looking good. Daily uptrend, very, very healthy right now. Be quite cautious, guys. We are in hourly overbought conditions, and even the 4 hours are starting to get a little bit overbought. So maybe if we push one last leg into this area, perhaps this is where we put an end to this daily leg higher, and then we maybe need to reset a little bit lower here, daily higher low formation, maybe before a future daily uptrend increase. So the trend is your friend, and right now it is looking very good. I myself would be more patient in waiting for a little bit of a retest rather than trying to chase this market into overhead resistance. Moving on to the weekly, guys, since we are now in a daily uptrend, we know that the weekly bounce is consistently underway, and we measure the size of the weekly bounce because obviously we lost the weekly uptrend, right? Clear loss of the weekly uptrend, so we want to get it back. So how much do we need to bounce to possibly get it back? Well, if you can come into this resistance area, 251.66. If we can come up here, guys, it sets up the bulls with enough space to be able to reset into a weekly uptrend, maybe later on in the month of August or maybe early September after those NVIDIA earnings. All in all, semiconductors, great recovery, looking quite good on them. Now, moving on to IWM Russell. So the Russell putting in a nice day, 2.59%, but I am still not convinced on the Russell here, guys. So moving on in, daily uptrend. Yes, daily uptrend is confirmed right now, looking quite good for them. Now, as soon as this move gets topped out, guys, we're going to be looking for a daily higher low, anything pretty much above 204, looking for that daily higher low for possible daily trend continuation to the upside if the rest of the market continues to cooperate, guys. This one will most likely not move on its own anymore. It will move as a byproduct of the overall market. You know, a few weeks ago, when everybody was forecasting for a no landing scenario and all the economic data was quite good, then you could have made an argument for the risk on trade. But now I still believe the risk on trade is back to being paused, same as it was for the remainder of the entire year that we just had, right? But still cracking above a level right now, 210 to 208. That was a big previous resistance level. Now we're back above it, so could be using it as support if we rally a bit more, breakout, retest, and maybe run, after which we'll be trying to test this resistance levels at around 218. Not looking too bad here, guys, but of course we know that we have lost the weekly momentum a little bit, so maybe the best we can expect is somewhat of a tightening range as the markets continue throughout this recession and economic uncertainty narrative, right? Risk on trade doesn't do the best in that type of market environment, so it's not my primary bet. Can it possibly run? Sure. But is it supposed to usually run? No. And I tend to stick with historical probabilities rather than just speculate, right? So moving on to the Dow Jones now. Dow Jones also performing beautifully today, 1.39%. Dow Jones, beautiful daily uptrend as well. As soon as this move is topped out, going to be looking for the setup for a daily higher low for further trend continuation. Where could we maybe pull back into? Well, keep an eye on this level right here. Was previous all-time high resistance. That is 39,900. Could be a level. All the moving averages are down there too. So if ever we choose to pull back soon, could be a little bit of a test and maybe ramp back up and start attacking these previous all-time highs. The Dow Jones as well never lost the weekly uptrend. Weekly higher lows are set. So in the event that we lose this daily upswing as well and consolidate a bit more in a daily downtrend, just understand, just going to be looking for a weekly higher low for continuation of the weekly uptrend. So the Dow Jones looking very, very good for a potential all-time high breakout right now. Let's move into crypto as well, because crypto has made a big move today. So moving into Bitcoin, haven't done this one in a while, but you guys know this was the massive asset sell-off, and we have not had as good as a recovery as something like the SPY or the QQQs, right? Still a risk on asset. So moving on down, we had a nice bounce, but the bulls lost it. Daily downtrend. So now we are battling once again with this big area of support, right? This whole 57 down to about 55 region is the cannot lose area for the bulls, because if you lose that and then use it as resistance, right? You've seen we've recaptured it a few times in the past, guys, but it's a saying in the markets, right? If you knock on a door 3, 4, 5, 6 times, eventually somebody will open the door, right? So just keep in mind that, guys. I am very bullish on Bitcoin right now. I did buy a little bit of the dip today, but I'd be lying in telling you that there wasn't a distinct possibility of us maybe testing the lower $50,000, maybe even $45,000 levels. That, in my opinion, would only happen, guys, if we get a round 2 of destruction across the SPY and the QQQs with negative data. For now, when markets are relatively tame and muted, maybe the most drawdown we can expect on Bitcoin is maybe the lower $53,000, $54,000 range. So I am a buyer up here, but cautiously optimistic. I still love it for the long term, but in the short term, guys, it may be very, very, very volatile. And the bulls still have a lot of work to do if they want to recapture any form of weekly uptrend, right? First, they need the daily uptrend to be reset. Then we look to the weekly. Still a lot of room to get that done on the weekly. And then, of course, need to eventually recapture that monthly as well. On the monthly, though, looking fairly bullish. In my opinion, this is still just a massive monthly bull flag for potential trend expansion when the macro environment gets more clear and better. Into Ethereum right now, guys. Ethereum is just very, very, very weak as well, right? So daily uptrend attempt by the bulls right now, you can see we almost gave it all back. So if we lose these lows, 25.09, they will lose the entire daily trend attempt and maybe just set a weekly lower high into further recapture of the lows for the bears. That would be pretty much 22,300. And that is where I'm going to be patiently waiting for Ethereum myself. I don't have as large, not even close as large of a position in Ethereum as I do in Bitcoin, but can still have some price appreciation in this one in the long term. 22,300 would be an area in which I would be willing to, place a bid for Ethereum, in my opinion. So that's pretty much everything for crypto. Now let's dive into our big tech names and then my portfolio. So moving into Apple, Apple's recovery continues, guys. 100% engulfing move. Apple just has not put in any single red day, guys, in the past 10 days of trading. Extremely strong recovery by them. But all good things come to an end, guys. Eventually, this rally will subside and Apple will have to consolidate on the daily. Just keep an eye on this hourly trend. If you lose the hourly trend, lose the 12 EMA, that will finally be daily consolidation for the stock. And where could we possibly consolidate into, guys, is this most recent level of support that is right below us, right? So this green box right here, 220 all the way down to roughly 215, could be a simple break out of the range, retest of the range, and then possibly rally. That would be an inverse head and shoulders for Apple and could be a catalyst to send them to their all-time highs. Personally, myself, though, I still have my hesitations on playing Apple, guys, just because of the valuation. The valuation on this one is very, very, very expensive. There's better deals in the market right now. You need to look no further than really companies like Amazon, Google, and even Microsoft, who have sold off, are still down considerably from their all-time highs at a much cheaper valuation than Apple right now, right? So Apple, still have my reservations in playing it. One thing's for sure, if we do revisit the lower range of this, 214, I'm going to be looking for short puts under 210. Under 210, think 210 and about 205. That's where I want to be playing my options credit strategies, right? Right now, still a little bit too high, but the bulls are in full control, right? Almost recapturing the weekly, or a good portion of the weekly as well. Take a look at this, right? 65% bounce on the weekly. So even if we get a little bit of daily weakness, right? If we lose this, end up in a daily downtrend, just understand the bulls will be looking to reset the weekly into an uptrend later on in the month of September. Now, moving on to AMD. Give me another quick second. AMD, 4.7% to the upside here, guys. Very nice performance by AMD. Great recovery off the bottom and a new daily uptrend, right? Very nice. Coming into some big resistance, however, keep an eye on the 150 to 155 area. That is where this whole area of upside resistance starts for this stock, right? So looking very good as of now, but just be mindful that the upside is potentially being capped very, very shortly because that resistance is definitely no joke, guys. It was resistance. Sorry, I'm talking and doing something else at the same time. I need to update these more often. So in terms of the resistance, guys, just keep an eye, right? This area has been resistance for the entire year. So the bulls probably won't be able to get through it in one clean shot. Maybe we end up with a rejection at resistance and then a daily higher low attempt and then make an attempt at it again, right? That's the type of scenario that I would think that would be the most likely on AMD. That being said, if for whatever it's reason we retrace right from here, just gonna be looking for a higher low, anything above 128, looking for a daily higher low for further trend continuation. And keep an eye at this level right here. Might be an area where the bulls put a stop to the bleeding. That is your 137, right? Big support here, a little bit of resistance. That is the closest area that we have in relation to the current pricing. Looking very good, however. Now, in terms of the weekly, since we have a daily uptrend, we know the weekly bounce is official right now. In terms of the size of the weekly bounce, need to get at least as high as 50%, which would be that 155 mark, right? Because what we need to do is recapture the weekly uptrend as well, because we've lost everything on AMD. We've lost the monthly into a downtrend, we've lost the weekly, right? And we've also had lost the daily, and now we've recaptured it. So we need a lot of work left on AMD, but I still love playing this company, guys. I'll continue to play it in the next few weeks. 140 to 120 is the key area that I want to be making most of my plays on AMD. Sorry, 140 to 130. This area right here, writing short puts down here in this location is a juicy endeavor in my humble opinion. The valuation down there is quite cheap, and we did it after their earnings. 1.18 peg at 145, right about where we sit right now. Moving on to Amazon right now. So Amazon also with a beautiful day, 4.4% to the upside. Almost filling the gap from your pre-earnings, right? So Amazon has been one that's run away from me as well, right? I was able to get a few positions in here, but not as many as I wanted at all. So Amazon putting out together a beautiful 10-day rally as well. No real red days, always putting in higher highs, higher highs, higher highs every single day right now. So as soon as this move has topped out, guys, you will know that at this point we are expecting for an establishment of the daily higher low for a possible daily trend change. We are running into resistance right now, which is pretty much exactly where we are, right? This whole 178, 180 level, very big area of resistance. However, we're now just crossing through the larger area of support. I know it's confusing, but this area, this green box right here, big prior resistance of the all-time highs. We're trying to get back above it on the weekly, right? If we can get slightly back above it, we may be able to use it as support once again and go for the weekly trend recapture, because we know we lost the weekly move with this section right here, right? So Amazon's still looking good, but I will be patient on this one myself. I will be waiting potentially for that dip, maybe back down into the lower 170s, trying to set up for the daily higher low and the trend change. I like it better here in the lower 170s myself for a little bit of a swing trade, right? So we have to be a little bit patient with Amazon. And if ever it runs away from us here, guys, then we're going to wait for it to break above this green box and then possibly retest the green box. Right now, still in a little bit of in-between area, a little bit too close to the resistance. I'd like to see it get above and then retest for the best trade risk to reward, in my opinion. Now, moving into Google, Google has been one that's been kept relatively low. So comparatively to the bounce of Amazon, of something like Apple and Amazon, right? Google is still relatively cheap, and Google is following the price action that I expected to have more in the indexes and big tech names, right? Rally off the bottom, set up the daily higher low, and then go for the daily trend change attempt rather than the straight V-shaped formation. So this is still solid for Google, right? Trying for the daily trend change, need a break of 166.57 to get that daily trend change underway. And then we have overhead resistance starting at about 171 all the way up here. But Google looking good. Now, because we have a baseline down here and down here, I can now base my short put trades around the low points here, right? So in the next few weeks, I will be looking to write short puts, guys. Anywhere 158 all the way down to about 155 could be a great location to lock in some put credit spreads or short puts before we maybe embark on a next leg higher. In terms of the weekly not having the best bounce at all right now, as you can see. Google's still relatively close to the lows, so we need the daily uptrend shift to be sure that the weekly higher lows are set with this low right here. If not, we may just be greeted with a little bit more downside. If that is the case, then 153 to about 144, that is the key location for me to be adding heavy Google shares. Big previous all-time high resistance, newfound support for the stock, so I like it in that location. Now, moving on to Meta. So Meta up about 2.01%, smashing through this big all-time high resistance, guys, and Meta is very close to setting a new all-time high at 542. Meta would be the first of your big tech names after the sell-off to set a new all-time high. This company, guys, it's impossible to slow it down. I've told you guys time and time again why that's the case, because of the free cash flow yield and because of the valuation. It is one, if not the most attractively valued stock in entirety of big tech right now, even at the all-time highs, guys. Extremely good and extremely cheap for this company right now. That being said, gorgeous daily move. Eventually, when this move does top out, going to be looking for the daily higher low for continuation of the daily uptrend. So just waiting for a pullback right now on Meta. Everything else looks very, very good right now. Fully engulfing move on the weekly too. So in the event that we are not able to breach the all-time highs and we run into a little bit of pushback by the bears right there, just understand we'll be looking for a weekly higher low. That would be possibly a cup and handle for some new all-time high push. I will be waiting for that pullback myself. I don't really want to chase it up here, even though it is fairly valued. If I can catch it on a little bit of a dip down here, maybe below 520, 515, that is where I would consider making a daily higher low attempt, using all of this previous resistance, which is now support, using that all and trying to base my trade off of that. That's everything for Meta. Moving on to Microsoft right now. Microsoft also looking very, very solid too. Another 1% day to the upside on Microsoft. And Microsoft doing just a great job of trying to engulf the most of this move as it can, right? So take a look at the size of this retracement right now. We are almost 85% retraced. So entirely almost engulfing move by Microsoft bulls. Still no pullback to set up the daily higher low for the trend change, right? So be very careful. There is resistance above us right now, sitting at about 423 up to about 435. This red box was resistance for Microsoft for a great majority of the first half of the year. So it wouldn't surprise me if the bulls get a little bit tired here, then maybe go for the daily higher low setup for the eventual trend change. Where could I see the daily higher lows? Just based off of previous levels, right? 410, 408, same thing right here. So there is a little small level right here. So I would not be surprised if the price action may look something just like this before resuming trend to the upside, right? Obviously, they can do the improbable and just moonshot from here, but normal price action would warrant something more like this, and that is something that I will be waiting for. I'm happy with the Microsoft positions that I have built up from down here, so we'll just ride those currently right now, and if it offers us more re-entry with a little bit of a dip, I will add to those positions. So looking very good for Microsoft. Even on the weekly, they're trying, right? Beautiful reaction off of our support zone, trying to get the bounce more underway with more legs. But so far, the bounce size is not the best, only about 38.2. So still a lot of work to do on those higher timeframes by Microsoft. Now moving it down to Netflix. Netflix, 0.23% to the upside. Netflix just fully engulfing move as well, right? Gorgeous move of price action by Netflix. Clearly above the moving averages right now, and clearly above our box of prior resistance, 634 down to 603. So let me just change this box from red to green right away, and you'll understand why I'm doing that. So eventually, when we do pull back here, guys, could be a testament for a breakout, retest, and run trade. So keep an eye on this level right here, guys. 640, all the moving averages there as well, and the start of our big box of support. If we pull back into this location, could be a good opportunity for some call debit spreads for a trend continuation to the bulls. On the weekly is looking gorgeous as well. Very nice move, very nice push up on the weekly. 80% recapture by the bulls from the entire move down at the early part of July. So even if the bulls lose a little bit of ground here, setting up a new daily downtrend, just understand, just looking for a weekly higher low for potential trend continuation to the upside by Netflix, looking very, very strong. Now moving into NVIDIA. NVIDIA also looking pretty good today, 4% to the upside, cracking clearly above the area of resistance, 119 to 115. Daily uptrend steadily underway right now. So as soon as we end this move to the upside, looking for a daily higher low, anything above 98.51, tons of space, guys. Anything above there, looking for a daily higher low for further trend continuation. Keep an eye on the short-term moving averages, guys. Down here, 114 to about 110. That could be a likely area where we maybe pull back into and set up for trend continuation. On the weekly, looking very good. It was a weekly downtrend. Now we look to the size of the move by the bulls, looking very attractive right now. Almost a 75% retracement, very, very solid. So even if the bulls lose a little bit of ground heading into earnings here, just understand it is for a weekly higher low for a possible weekly trend change back to the bulls. NVIDIA looking very good. I'm not chasing it up here. We'll wait for a little bit of a retracement here, guys, and then most likely writing short puts, 107 down to about 100 if I can find them. So looking very strong on NVIDIA. Congratulations to everybody who played the dip with me down here. Moving on to Tesla right now. Tesla, 6.34% day to the upside, looking very, very strong, right? Daily uptrend continues to be in effect by Tesla right now, so looking quite good. So the daily higher lows are right here, as a matter of fact, 191.50. So any move lower above 191.50, looking for a daily higher low for continuation of the daily uptrend, possibly sending us into the next area of resistance, which is roughly around the 230 mark, all the way up there, right? So Tesla is still battling in this zone, guys. 230 down to about 200. Very wide range, right? Big previous support, congestion, resistance, support here as well. Then we had resistance for the markets, resistance. Huge zone right now, guys, and it's going to take Tesla a lot to get out of that zone. In my opinion, on the weekly, because of the size of the pullback, we may just be expecting a tightening range here on Tesla as we await better data from the consumer and as we await those interest rate cuts. Obviously, Tesla will respond decently to interest rate cuts, but do not expect demand to resume in the snap of a finger, right? It takes time for consumers to get back to buying vehicles. So just keep that in mind. As per myself, as per usual, guys, I will not be playing Tesla that much. Only if we get a revisit, guys, of the lower, maybe, below 200, right? Think 200 to 190. Then I may be looking to play 180, 170, 160 puts, but not before. I just don't trust Tesla just yet. I don't think it is quite ready here, guys, right? Still a lot of time for Tesla's fundamentals to possibly deteriorate a little bit more. Moving on to Palantir. Palantir just continuing its monster move to the upside. Bulls looking extremely strong right now, clearing this area 30 to 29, which was our previous big 2020 and 2021 area of resistance. And now the bulls are clearly above it, right? So what we might be expecting soon as this move is topped out, we are not daily overbought just yet. Even on the shorter time frames, guys, 4 hour barely overbought, and even the 1 hour not overbought at all. So the bulls have just been doing a masterclass in grinding higher without having overbought conditions. So as soon as this move does top out here, guys, look for the daily higher low setup. And if we do pull back, this is the area that I'm targeting. $29 down to $28. That could be a perfect breakout, retest trade and run. That's the one that I'm looking for. On the weekly, things are looking very good too. Weekly uptrend continuously in motion, right? So even if the bulls lose a little bit of ground right here, just understand we're just looking for a weekly higher low for further trend continuation. That's why I'm targeting this 29.28 for an initial swing trade. And if ever we just blast through it, guys, the next swing trade area becomes 26 to 25 to be writing some short puts. So if we come down here initially, maybe looking for some call debit spreads to the upside. And if we blast even lower, I'll probably hold on to these because usually when I do call debit spreads, they're 2-3 months of time. And if we do come lower, this is where I'd be looking to be writing some short puts, 26 to 25. All in all, Palantir looking extremely strong, even on the monthly, guys. Look at this monthly chart. Beautiful monthly trend expansion. So looking very good. That's pretty much everything I had for you guys in terms of our stocks rundown. Now let's dive into my portfolio for a very brief recap. So taking a look at the portfolio right now, guys, before we go through the ones that we do still have, let's go through a bit of the ones that we did close. So we had a few earnings plays leading into today. One of them was Cisco. We wrote the $40 puts for earnings for about 14 cents. We closed them for a penny for 95% profit again. A very good trade there. Also, the SoFi position was closed as well. You may remember that. We got about 15 cents for them earlier on in the week, and we closed them today for about 3 cents. So about 85% profit on those. Very nice wheel trade as a whole. Then as well, we sold the Micron. The Micron, these were call debit spreads. We got into these call debit spreads for about $1.10, and we closed them this morning for about $1.85. So over 50% gain on those contracts in just one single week. I will take it, guys. Very good trade on those, right? So some consistent profits there. We also had a decent fill on Walmart too. So Walmart, we made an earnings play before the close yesterday, 62.5s. We got 23 cents for them, and we were able to close them pretty much almost worthless here, 90% plus profit for just about 2 cents. We also had some Baba earnings plays. You might remember we closed those for a penny each. We got into them for about, you can see one for 22 cents here, and just earlier 20 cents. So once again, 90% profit on those as well. A few other ones that we closed too in terms of earnings plays. ASTS, we had the 13 puts. We closed them for a penny. We got into those yesterday for about 10 cents. So another 90% profit trade there. We closed the CP. We wrote these earlier on in the week for about 30 cents. So we were able to close these for about 5 cents this week. When we got them for 35, we closed them for about 5 cents. Once again, guys, close to 90% profit. This was a traditional wheel trade, nothing fancy to see there. And I think that's pretty much the only other ones that we closed today for a profit. The one that we closed for a loss today, because yes, sometimes we do take losses, I had to cut the Wingstop position, guys. This was a call debit spread, and we were expecting Wingstop to go down after their earnings, but just because of the valuation and because consumer discretionary spending was lower. We've been hearing it from other quick service restaurant brands, and the valuation on this one is just extremely, extremely high, right? I'm not too sure why the valuation isn't popping up. Did I hide it somewhere? No, but anyways, the PEG ratio is over 5.6 right now for Wingstop. So we took, this is where we took it, 367. We were expecting a drop and roll over, and unfortunately, when we get the break into a new daily uptrend, I have to close the position. So we did take a loss on that one, guys. This one, we got it for about $410, and we closed it today for about $200 on the debit. So we lost about $210 on that play in 2 weeks. So, some you win, some you lose. This was one of the rare losses that we took in the most recent couple of weeks in terms of call or put debit spreads, right? Now, we did also close the TMF and TLT, just the TMF ones, just because, I'm going to be waiting for a little bit more of a pullback here on TLT. So we went out of the higher leveraged version of that, TMF. TMF was a decent trade here, guys. We didn't get too much profit on them, but keep in mind, we've only been in this one for just a few short days. We bought this literally about a week ago. And you can see we profited, not too bad, just about $1.60 per share on 25 shares. So not that much profit, guys, but still a decent little bit of amount of profit, right? Couple percentage points in just 5-6 days of trading. And then we also closed let me go back to the previous page. We also closed the TMF calls that we had right here. Just looking for better pricing here, guys. In the event that interest rates just hover around here until the rate cut, I'm looking for better pricing. So where are they? So I closed the TMF $45 call for November. We closed this one for $13. And I'll remind you guys, we got into this one for about $12. So just over $100 in profit in just one short week, which is very good in terms of ROI, right? You can't be mad at the ROI. It's about 8% in just a few short days of trading. So I'll take that, guys, just adding to the profits overall for the day. Not too bad of a day indeed, if I do say so myself, in terms of just closing trades, right? Now, in terms of the trades that we still have for the remainder of the week, well, we opened a new one here, an Airbnb bull call debit spread. So this is the 125s versus the 130s. We got them for about $1.80 each. So I'm going to be looking to ride these out. I'll probably close these if they can get to about $3 or just under. So we'll see how Airbnb goes. But just looking to buy the dip on solid companies here, guys, right? Airbnb, really, really low. I told myself I'd only throw one contract at it. And if we dip a little bit lower, guys, I'll be adding one more for the eventual rally. And you can see right here, they are for November. So a lot of time left on those to either DCA or ride it out. We also have the Applied Materials earnings play, 190 puts. That was 2 times the expected move. The expected move was about 4.5%. We went about 10% below the current price. We got about $1 on those, so very good pricing there for next Friday. Just looking to bring premium forward, guys. When the implied volatility comes out of the contracts tomorrow, usually we're going to be able to close this one at a very good profit. So you can see right there, Applied Materials after the close here today, they're only down roughly about 2% if I move myself over right, just about 2% worth of decline. So we should be able to get out of those for a very decent profit as early as tomorrow morning. So that's it for that one pretty much. The other ones are going to be, let me just go through these real quick, right? So let me go through the Amazon plays and AMD plays because I got a couple questions on those, right? So AMD, you can obviously see here that we've been covered. We covered up leading into the drop. We had consecutive covered calls going lower and lower and lower. The moral of the story, what you need to understand is that we got assigned at AMD at 139. And after receiving a bunch of covered call premium, our average cost is now about $134. So you can see right here, the last contract we have is the $128 calls for $8.30 at this point, right? So it stands to argue if I let myself be called away tomorrow, we get 128 plus 830, 136. We'd only make $200 on our AMD position, right? All in all, because our average cost is down to 134 and we'd be selling just above 136. Now, admittedly, guys, we just played defense, right? So the reason that I kept these on is because we were worried that the market may have a second leg of selling down. And instead of pulling a complete V shape like the SPY has done, maybe we're more in order for something like this, right? So I was playing defense and was not anticipating the quickness of this rally to the upside. So when you play defense, obviously you're not going to get any gains to the upside. So admittedly, guys, this is one that unfortunately for me has just run away from me right now. We cannot get enough premium when we roll 1 week forward. So I may just let these get called away, take my tiny little profits and just reset with some short puts, right? Because it serves me no purpose. If I can't roll these for a premium, why would I hold all this buying power, right? I can always take the calls off here at 147 and take my chances for more upside, but it's a little bit of a risky proposition, right? I'd rather just take the entire position away, take my small little profits and just reset with some short puts a little bit lower than current price right now, right? That's probably what I'm going to do on AMD. And the same thing for Amazon, right? So Amazon, right? Same thing, right? We got assigned at 190 minus all the premium received from the puts and all the covered calls we've been writing throughout the drawdown. Our average cost is sitting right now at about $175. So you can see right here, we played very, very big defense, right? At 160 with in the money covered calls. We did some good jobs rolling them over the past couple of weeks, but still, right? If I let myself be called away this week, we obviously know Amazon's trading at 177. If I let myself be called away at 160 plus our credit 767, we get out at 167. Let's call it 168, right? Our average cost is 175. So we'd be losing $800 there if I let myself get called away. But what's the flip side? The flip side is we take these covered calls off at a loss and we potentially go for further upside recapture in the stock from here. Kind of a risky proposition leading into resistance, right? Which is why I might just get called away, take the little loss on Amazon because we weren't expecting a tremendous rally like this, right? The reason we were playing defense is we were expecting more consolidation at the lows and more time potentially before this recovery rally, right? Not many people were expecting the true V-shape on the SPY and the QQQs, myself included. So that's why we played defense. But unfortunately, playing defense, sometimes it bites you in the ass, right? It's just a fact of the matter. And this is going to be a loss for me if I let this get called away tomorrow. But I can't really roll them for any more premium. So the best thing to do is take this AMD buying power, let this expire, let myself get called away for a slight gain on AMD and a loss on Amazon, and just get all the buying power back and possibly be able to reset a little bit lower than the current share price, right? That's the best thing that I can possibly do right now, in my opinion, and it's probably what I'm going to do as of tomorrow. So hopefully that covers things up, covers some things up for you guys that are curious, right? Tried to play defense. It worked, and then the markets really ran away from us. So obviously, that's when we kind of take the hit. But guys, as I always say, it is more important to manage the risk in times of high uncertainty, guys, right? Nobody has a crystal ball. So the best thing you can do is play defense to prevent from further and further and further drawdowns, right? So that's pretty much the fact of the matter on AMD. But as you can see, I do have a little bullish position on AMD right now. We have a bull call credit spread. We don't have any more bullish positions on Amazon. I'm looking to load up a leap. If we can get a little bit of a dip and consolidation, I would consider a leap call option, possibly for next year and reset. I had one of those back here after earnings. Did very well for us. We cut it pretty much over here. And now I'll be looking to get right back into that same leap call option for 2025. Now, moving on further, we took a tiny little position on Bitcoin. So you can see this is the Bitcoin 2x leverage ETF. So we did it a couple different ways. We took a Bitcoin position late in the afternoon. And then as soon as I took the position, guys, 5 minutes after, not even 5 minutes after, Bitcoin had a top to bottom decline right there of about 4%, right? So classic, get into a trade and it drops on us right away. So thereafter the drop, we wrote the $24 short put for tomorrow expiry. We literally got 1% in premium. So we'll see, small position as of now. If we get a sign, it'll be a bit bigger, but still manageable. And we also have somewhat of a longer term call option, 17.5s. At the time I got them, I got very good pricing. Keep in mind, at the time we were in the 27s, right? So to pay $11.90 with a 17.5 strike, right? Plus 11.9, that was only a premium of 229.4, which was only above where the stock was trading, right? That was only $2 above, which is about 10% above. On a 2x leverage ETF, that's very good extrinsic value premium pricing, which is why I got it. We'll see how this one moves on. But as I said, I will be buying the dip on Bitcoin. This is just an initial dip buying opportunity, right? Now, moving on further, we had the John Deere. We had the John Deere plays right here. So the bull put credit spread, that expired worthless. We already closed one of them. Let's see if I can find it in here. Yeah, we had another one, the 310s versus the 305s. We got 20 cents, $20 on them yesterday. We closed them for $2 today, 90% profit. These I'll just let expire worthless, another $20 there. We still have the bull call debit spread. We've been having this one for about a month now at this point. Still gonna ride this one. This is due for December, 400 versus the 410s. No change in anything else. Dollar Tree puts should be expiring tomorrow. They're almost worthless. Elf Beauty short puts should be expiring worthless tomorrow as well. They're almost there. EVVTY swing trade going very well. Google, we have a bull call debit spread that I opened today on Google, right? We're looking for the retest and higher lows. So this is what I was waiting for on Amazon and other companies too, the higher low retest. So we got a bull call debit spread, looking to ride it into the future. We got decent pricing on those. This is for October as well, 2 months of time, $1.59. I'll be looking to close these when they hit maybe 250, 270, something like that. If Google can rally into the 170s. Below that, we had the H&R Blocks earnings plays. We got 16 cents for the $50 puts. So that was pretty much 2 times the expected move as well. H&R Block now in the after hours up 9.93%. So those will be worthless come tomorrow. Very good premium there. You can see, guys, very good trading session. The Intel calls are going good. McKesson swing trade's a little bit down on that. Microsoft swing trade doing good. Still have the bull call debit spreads on Microsoft too. Nike call is doing very well, almost a 2x on those. I'll close these probably when they do hit a 2x. But that's pretty much it. OXY, $56 short puts. Those are pretty much worthless. So all the wheel trades for this week played out fantastically. And I do still have a TLT $100 call for May of next year. I'll probably hold those. And I also open a UPS bull call debit spread for October, 135 versus the 140. 2 contracts got $1.08 for them. So they are a little bit out of the money here, guys, but UPS is crushed. So I'm just looking for that trend recapture throughout the months of September and possibly October. If we can get close enough to a 135, maybe even in the 130s, then this contract should perform quite well. Probably going to be looking to close these maybe $1.60, $1.70, maybe close one there and leave one to ride all the way to $2 for a 2x, right? So that's pretty much everything that we had in terms of positions today. Hopefully you guys enjoyed that. If you did, consider dropping a like on the video. Would appreciate it for the growth of the channel. Second, if you're new here, consider subscribing. We do these videos every Monday to Friday after the close. So hope to see you back at a future video. And lastly, if you have any questions at all, guys, please leave them down below in the comments. Anything you want, stock analysis, technical analysis, options trade, recession discussion, anything you want, leave it down below and I'll usually get back to you in the first 24 hours. I'll be answering a ton of questions tonight, and Saturday I will be doing a subscriber request video. Haven't been doing them for various reasons that I was busy in the past 3 weeks, but now we're going to catch up and do one big one on Saturday. So hopefully see you guys tomorrow after the close. Take care, happy trading for tomorrow, and peace.